Payment in kind is a form of additional debt that private credit managers offer companies when the capital structure uh, in the cash flow of the business, don't match. So typically, what happens is, if there is a company that is growing and the leverage is high, certain private credit managers offer payment in kind as a form of additional debt to, grow into that capital structure. And it's an instrument, to be honest, has been around for 20 plus years. If I think about the buyouts of 2006, 2007, right before the global financial crisis, the mega buyouts of TXU, Univision, HCA, that were levered 9 to 11 times cash flow. There was no way that those companies could support the interest, the cash interest burden of that debt. So, very smart bankers created this concept of payment in kind, a big toggle. Clearly, post the global financial crisis, some of these companies went bankrupt. The pendulum swung from super levered capital structures to a little bit more moderate, more in the fairway type capital structures. And then during a low interest environment that we had from 2010 through back in 2022, you really didn't need it, right? And so what's happened over the last 3 years, with rates increasing 500 basis points, with some private credit managers being a little bit more aggressive in terms of pushing the leverage, the whole concept of PIK has come back into people's portfolios. And so there's two things to think about payment in kind. One is as a way of being proactive and trying to win deals by pushing the leverage. Two, as a way to fix a business when the company is not performing and the private equity sponsor is asking a private credit manager to defer cash interest for a period of time so that they can fix the business. So payment in kind is something that's been around for quite some time. It's come back into the mainstream over the last 24 months. As people have created these portfolios, you want to make sure that the portfolio is stable. You want to make sure that the portfolio can actually generate the income that that manager is promising to its investors. If there's a big chunk of that portfolio in the form of payment in kind, it means that the portfolio is probably a little bit more levered than it should be, or probably means that there's more restructurings in that portfolio that than a typical portfolio should have. And so, as a diligence matter, I think it's important to look at the portfolio in general, but also how much of that is cash pay versus payment in kind. And so, from an investor standpoint, it's a really good indicator of the health of that portfolio. We have been very consistent in our senior debt strategy for many, many years not to push the leverage. So you could look at deals that we're doing 2010, 2011 to deals that we're doing today. Our senior debt book has been levered 4 to 4.5 times. Right? When you have leverage at that level, and the businesses that we finance are usually high free cash flow businesses, they can support the interest burden of that loan, right? And so, from our standpoint, when we look at creating a portfolio, the fact that we've been quite consistent and diligent about making sure that that portfolio is not over levered. The benefits of being conservative is that you get a portfolio that's predominantly cash pay, right? So and we're proud of that. And if you look at the stats out there, I think one of our publicly traded BDCs, PFLT, our PIK percentage is negligible. I think it's 3%. When you have other managers being at north of 15, 20%. And so I think for us, being disciplined on a long-term basis in terms of how we build these portfolios has boded well for us. And it's important for our investors to make sure that what we are delivering to them is cash, right? And not putting excess risk on the portfolio.